From Washington, this is the HPS Macrocast with Hamilton Place Strategies and Markets Policy Partners.
Good morning. It's Friday, December 6th, and you are listening to the HPS Macrocast. I'm Matt McDonald, in for Tony Fratto this week. I'm here, as always, with John Fagan and Brendan Walsh from Markets Policy Partners. Today is Jobs Day. We have numbers hot off the presses.
Big numbers.
Big numbers. It is a strong jobs report. Let's go through the top line real quick, and then we can just kind of talk about it and some of the implications. So the headline number, 266,000 jobs created in November. The unemployment rate went back down to 3.5. We talked about that a little bit last Jobs Day. That wasn't even when it ticked up to 3.6. That wasn't particularly material. So
yeah, and it was like a hundredth from rounding down. So, yeah,
in kind of the same zone. Labor force participation is at 63.2%. Notable in some of the numbers, a couple of pieces. So the manufacturing numbers were good, up by 54,000, though the GM strike.
Yeah. So that was about 40,000. So, I suppose if you look at this whole number as a whole, it's probably more like a 220 number, which is still amazing,
right?
Because we lost 40 last time, and
but
we
even
had
within
53 back this time.
But even within some of the conversations around soft manufacturing, this is great.
Yeah.
Other pieces, the wage numbers are strong. So the trailing 12-month hourly earnings increased 3.1%, which is great.
Which was up. It was 3, and it had been declining the last couple of months. So we're back on an upward trajectory.
And then revisions were strong too. We had September was up 57,000, and October was revised up also. And with those revisions, and then with the 266, the trailing 3-month average is now over 200,000 jobs, which is up from where we were earlier.
And it's pretty unprecedented in a 10-year economic expansion to still be producing these kind of job gains.
Yeah.
Heck
of a soft landing.
No, I totally agree. This one kind of reminded me of 2016, where oil prices were coming down and everyone started worried that we're going into a recession, and then we had a couple huge job numbers. Here, everyone's kind of worried that we're going to recession because of trade, but it seems like just everyday businesses aren't that worried about it.
Yeah,
and the actual core of our economy is doing quite well.
Okay, I'm going to jump in and be the Grinch. Okay,
yes.
in all of this happy holiday mood, I'm going to try to spoil it. If you are the sort of traditional way to pour cold water on a good labor market number, if you are of that mindset, I'm not saying I am. The overall U.S. economy has been kind of a mixed bag, but we've seen really persistent strength in the U.S. labor market, but from a macro perspective, typically jobs numbers are considered a lagging indicator. Non-farm payrolls tend to drop after the rest of the economy has softened up. As everybody knows, hiring is a lengthy process, and people that are being hired now started to be hired, a little bit.
It is a very sticky market,
right? And there, just as another Grinchy kind of point here, the ADP number, the ADP number, which precedes the more closely followed non-farm payrolls by a couple of days, was a pretty big downside miss earlier this week. It was 67,000 for November versus a forecast of 135,000, and October's 121. That's not a horrible number, but it was a big miss, and it was basically ADP is not a predictor for non-farm payrolls, but the correlation is understood.
But the largest input to the ADP number is the previous 3 months of the non-farm. So the ADP really isn't particularly a good number at all.
It still leads people, and traders were. The whisper number, so to speak, on Wall Street was a little bit lower, a little bit light for this non-farm payroll. So the market reaction that we saw wasn't. It was too obviously a quite a meaningful reaction to a huge upside surprise.
Yeah.
But because
consensus was 180, but I agree with you.
The whisper
number
number
was more like 130, 150.
Yeah. People were traders were bracing for a slightly lower number. We saw treasuries rallying tentatively into the number, and you can kind of see which way traders are leaning. And then they got a bit of whiplash.
But this doesn't fundamentally. I mean, one of the previous conversations we've had on this is that from a macro perspective and where the economy is going is that people are basically discounting any sort of recession risks in the near, say, 1 year
Certainly
time
in the equity
horizon.
market,
Even at whatever dark lining to the cloud or cloud to the silver lining you can find. I mean, that hasn't fundamentally changed, right?
Well, the Treasury market, when the Treasury market is still, it's not. We talked a lot in over the summer about the dreaded inversion of the yield curve, which is the 10-year yield dropping below the 2-year yield, which is a dire foreboding warning of recession and is a very accurate predictor of recession. Now, there are lots of questions about the validity of the signal, which we saw was a very brief 2- and 10-year inversion, so on and so forth. And since it is steepened up, everybody has put recession, that has really helped people put recession fears aside. And that's along with a stabilization of the weakness that we saw in Europe and other places around the globe, in China and so forth, which was assumed to be the sort of leading edge of the global synchronized slowdown that would eventually drag the U.S. down into a 2020 recession.
Isn't it the case, and I may be misremembering this, but I always thought that the yield curve inversion has a tendency towards the false positives, that it predicts more than actually happen, even though it is a good predictor. Is that true?
I think the last false positive was actually in the 60s of the 2- and 10-year.
It can be very early, but basically every time we've had a recession, it has gone inverted.
In terms of false positives, I'm not sure how many false positives we've gotten, but it's and there's also a question about the duration of the inversion.
Right.
If we had a very brief duration, a very brief inversion of the 2- and 10-year, and typically market participants look for kind of a quarter or a couple of quarters of inversion as really a solid signal for this.
And actually, every time it's inverted, the average stock market return over the next 12 to 18 months is like 35 to 50%. Mm-hmm. So it's not the time. It's actually the time to buy stocks, because usually that means that the Fed gets worried and starts cutting rates, and then people get excited and buy stocks, and then you go into recession, then you want to sell.
Just a last point on the funky yield curve. The classic, what they call Goodhart's law is a famous economist said, as soon as an indicator becomes a target, it no longer is a good indicator.
Yeah.
And
that's a great point.
And in 2007, when the yield curve inverted, it was a curiosity. It was not the same import. It was not as widely understood back then. It was just, look at that. And this time, it is absolutely a target. The Fed targeted its policies to disinvert the yield curve, I believe, and that their commentary from Fed officials really has played that out, and certainly we've seen that from the European Central Bank as well. One of the reasons they drop the policy rate into negative territory is to keep yield curves from giving this dire signal.
We think about that the Goodhart law, the aspect of like measurement ceasing to be helpful, is we actually think about that in management at the firm, is like, okay, like you got to be a little circumspect about how you value what the work is and how people are doing and that sort of stuff, because people will freak out on that stuff and start gaming the system.
That's pretty interesting.
You have to be careful.
Yeah, and just a last point on the since I'm playing the devil's advocate, I guess, in this morning's podcast, in some ways, as the commercials say these days, just okay is not okay. This is an economy. We have dumped so much stimulus into this economy. This is a late cycle economy, and we have poured on the fiscal stimulus with the Trump tax cuts and basically 12 months of pretty muscular Fed easing, which although the Fed is on hold on rates policy, the I can't believe it's not butter version of QE, which is $60 billion of asset purchases a month, is still going on. That is a major liquidity injection along with the New York Fed's liquidity operations in the front. And this is a financial measurements of financial conditions. If you look at the Chicago Fed or the Goldman Sachs compiled financial conditions index, financial conditions in the U.S. are really, really loose.
Yeah.
And so with that, with all that,
right.
We should be getting like
and I think John is
good.
making a really important point. The economy is not as bad as the ISM is indicating. We're not in a recession. The economy also isn't as good as 266,000 jobs.
Sure.
So with all that we're doing, the reality is we're in a 1.5% to 2% GDP growth. Wages, while at 3.1% and up from 2 a few years ago, is a great trend, but it should be 5.
Yeah.
So things are fine, but it's not off to the races either.
So let's take a quick break. We'll spike John's eggnog while we're gone, and then we'll come back and talk a little bit about how DC is absorbing these numbers and some of the latest trade news and some other topics.
Perfect.
HPS is excited to share with listeners a new collection of analyses from the Aspen Economic Strategy Group titled Maintaining the Strength of American Capitalism. The volume rigorously examines some of the most prominent economic proposals of today, including antitrust policy, wealth taxes, Medicare for all, and universal basic income initiatives. The Aspen Economic Strategy Group is led by former Treasury Secretary Hank Paulson, White House Chief of Staff Erskine Bowles, and University of Maryland professor Melissa Carney. Macrocast listeners can learn more about the group and download the volume by visiting economicstrategygroup.org. And be sure to follow them on Twitter at EconStrategyGRP.
Okay, we're back with the Macrocast. So we're just touching on the economy, where it is, where it isn't. I think on the DC side of things, I think that there's, while maybe early in the year there was a perception that 2020 could have even prior to kind of Fed easing, 2020 could have a recession. We're super deep in the expansion that could spell trouble for the president's reelect, all that sort of stuff. There's a lot of water under the bridge on the economy. I think on the political side, and people don't follow it as closely or in the same way as the markets, but people have put some of that risk aside. But there's at the same time, DC is being enveloped by chaos around impeachment and other stuff. But there is, even as there's all this stuff happening, there's still a lot of material economic impact that Washington is having, even as people are obsessing over the latest debates on impeachment. So we've talked a lot about, over time, we've talked a lot about the China trade negotiations, and spoiler, they're still going on.
And spoiler, I still have no idea what's going to happen. I do think we get a deal, but who knows?
But I actually also wanted to touch on USMCA.
Very important.
So China is not our biggest trading partner. That is, Mexico and Canada are our biggest trading partners. And this is the replacement deal to NAFTA that was negotiated by the administration.
And even more important, with China, we buy stuff from them. It's done product.
Yeah.
The interconnection between Canada, United States, and Mexico is monstrous. We send things back and forth to build a car. It goes back and forth. So it's just very difficult to not have rules set up, because we've created economies that are very dependent upon each other.
Yeah. Well, it's interesting to observe this. So you have this, and this has been true throughout the Trump administration, is that even as there's been chaos at the top and in the headlines and all the rest of it, this stuff has gotten done. I think there's there's differing views on whether USMCA gets passed through Congress and where it sits in Nancy Pelosi's priorities.
Right.
I think the general assumption is that there's support for it in Congress, but we've seen some wrenches thrown into that process over the past week, and whether that's going to get done and when. And Congress is running out of working days before year end and that sort of stuff.
And from Pelosi's standpoint, so she has about 30 freshman congressmen who won in kind of red districts, who now have to go back. And they came they were elected saying, I'm going to go in and do something, and nothing has happened really on that front. So I feel like Nancy kind of needs to give these people something to go back and run on in 2020.
Well, it's a particular, it's a particular problem in terms of if there's not passage of something material that people can point to, is that it does lead into a bit of a trap around like Trump derangement syndrome, or just obsession with the president, and all you care about is impeachment, and you're not actually doing things for voters. And like, you know, we in our work we've seen some of the focus groups around that stuff, and that doesn't. I mean, that's fine for DC, but it doesn't wear well out in the real world.
That's interesting.
It'll be interesting to see how the fate of USMCA plays through on markets. We obviously see markets chasing the latest U.S.-China trade headline. It's almost embarrassing.
Larry Kudlow's on CNBC on Squawk Box for the last 20 minutes.
It's gotten a little ridiculous the way the markets chase every little nugget of incremental information or just hearsay on U.S.-China trade. They don't chase USMCA headlines in nearly the same way. So it'll be interesting to see how it plays through in the markets, whether it gets done.
It's kind of amazing. The administration has created their own market tool to be able to adjust expectations. It's like their own version of Fed policy.
No, it's amazing.
I mean, the stimulus response is unmissable, right? I mean, they learned it a year ago when the markets were in free fall in the fourth quarter, and they were pushing Larry Kudlow in front of the cameras every time the market was down to say something positive about U.S.-China trade talks. And so this has been going on. It's been an inexhaustible source of upside catalyst for U.S. equities.
But I also thought it was interesting.
Fodder for the Macrocast.
Yeah. But the president this week, when he was abroad, talked a lot tougher on the China trade, and kind of when he gets back on home soil, he talks back up the market. You know?
Yeah. So the other piece that we wanted to chat on is OPEC news, and take a look at energy markets and what that stuff looks like. We've had some really interesting kind of news and shifts in the way that the markets work in that space over time. So let's take another quick break, and we'll come back and chat on that in a second.
On the first Friday of every month, HPS analyzes the latest jobs and labor market data in a digestible format. Sign up for our reports at hamiltonplacestrategies.com or on Twitter at HPS Insight.
All right, we're back with the Macrocast. We haven't had a ton of conversations about energy markets, but it's if finance is one of the bloodlines pumping through the economy, energy is probably the other one.
Yeah.
Brendan, walk us through the news out of OPEC and where things are in those markets.
Right. So OPEC's been meeting, and it looks like they have reported agreed to about 500,000 barrels per day cut, which in the big scheme of things is a drop in the bucket. Yeah. Apparently Saudi Arabia has kind of already done that. The interesting thing about OPEC is, so they went from, in 2009, they're about 34% of the global share, and they're down to 30 and shrinking. So the question here is not like, oh my goodness, OPEC cut 500,000 barrels. It's more like, how come they're not cutting 5 million barrels?
And what was market reaction to it?
Nothing.
Well, oil prices have been up.
Yeah.
You know, they're up to close to the top of their recent trading range, but this is a 6-month trading range between, like, for Brent crude, the international benchmark, a trading range between $55 and $65 a barrel. That's not exactly eye-wateringly. Yeah. This is right in the middle of a multi-year range, and this has been a very flat oil price market. Volatility has been low. Even when we saw the attacks that took out half of, we talked about this in a previous Macrocast, half of the Saudi Arabia's oil production capacity in one drone and missile attack, oil prices, Brent crude spiked up almost to $70 a barrel, and then fell right back
from
down.
Like 65. It was like 5%.
It is incredible how little that moved the needle. Something that 5 years ago you would have thought would have brought Brent crude up to $150 a barrel.
But in that last 5 years, we in America invented the technology to tap into the shale.
Right,
And
the
just
US
last month,
we're a petrostate now, which is something that is like
no, we
slowly.
are. Yeah. So for the first time ever, part of it was because we changed the law and we're allowed to export it, but we were a net exporter of oil last month.
It is fascinating anyone who's been in the working world or paying attention to economics or markets for more than a decade, it is amazing how much it's all changed over that period of time. I mean, like on the political side, you'd always have these gas prices were always an election issue.
Exactly.
I mean, that stuff is just kind of gone. You have, I mean, who would have said like that, Venezuela would forget how to produce oil and the U.S. would be a huge, I mean, it's wild.
And before, when oil prices dropped, markets would generally, especially equity markets, would generally rally because it was a tax cut for the consumer. Now, actually, markets start to get worried because that leads to defaults in the Permian basis and job cuts.
In 2014, 2015, when oil prices crashed in late 14, early 15, I was in the Treasury Department at the time, and the economics departments were talking about that very thing, which is this is a tax cut for the U.S. consumer.
Yeah.
Effectively, we're going to be seeing that play through in consumption, but really the economic damage that it did in the middle of the country offset to a great degree the positive impulse.
Yeah, I mean, though, as we've seen in Venezuela, countries that have high dependency on oil production are uniquely susceptible to the whims of the market in that space in a way that, that'll affect parts of the U.S., but the economy just dwarfs. The U.S. is just a different beast in that sense. So
yeah, and Saudi Arabia is a good example of that. So they're going to do an IPO for their Aramco, the oil company.
They debuted yesterday. It was the largest IPO ever, actually, and it was $25.6 billion, and which sounds like an enormous, chunky number. But actually, the Saudi Aramco IPO was something of a disappointment. It was supposed to be a big international rollout. It actually only listed on the local Saudi exchange for local investors. It's very difficult for international investors to get access to that to buy into it. There was a lot of controversy about the valuation of Aramco. There was a sense that the Saudi royal family wanted $2 trillion or
that
something
was the number,
like that.
$2 trillion. Yeah.
It fell. Well, it was 1.7 trillion is the number, which is kind of in the lower range of what estimates were all over the place, and that's still kind of a finger in the wind.
it's tough to value a country. That's
right. And in the when they first announced that this was years ago when they first announced that they were pondering an IPO of Aramco, the first thing that a lot of market participants, a lot of people thought was, "Ooh, that's not a bullish sign for oil."
Yeah, it's like it's the ultimate signal of insider sales.
Exactly.
Of a company.
No, but this
unquote.
is a very interesting intersection between markets and geopolitics.
Yeah.
The Saudis have inside information. They know what's under the ground. They know what's the future of the country looks like. And essentially, they're trying to take future profits and take them today, which that's a little troubling. Wouldn't you agree?
Yeah, commodity giant Glencore IPO'd in 2011, just before commodities tipped over and crashed. Blackstone IPO'd in 2007, just before
all the private
financial
equity
markets
guys
seized up.
Literally at the
Goldman
top.
was a little early in 1999 when they IPO'd before the tech crash. But some of there's a lot of lore in financial markets about that sort of top ticking IPO that comes out.
But it's also fascinating to look at the macro dynamics. So we talked about U.S. becoming a huge energy producer. You also have the increase in use of renewables and what that stuff looks like. And
technological advancements are not going to stop.
Right, all of these things. And so, the era of kind of Saudi turning the spigot and controlling the markets and
last week Norway found a whole new.
Oh, the discoveries keep coming in, and every year, this year again, there are predictions that the U.S. shale patch is going to be running out. They're out of momentum next year. Production growth is really going to start to flag. There are thoughts that OPEC's rather minimal production cut is a bet that the shale patch is gonna stumble to some extent last year. But they say that seemingly every year, and production keeps surprising, and technological advances, they keep innovating. Now that may not at some point you're going to run out of you get diminishing marginal returns, but it's been consistently surprising. Now we obviously have Elizabeth Warren, as part of her presidential campaign, is talking about a ban on fracking, and certainly there are lots of environmental and others. It's a controversial issue, and it has been for a long time. And whatever side of that debate you're on, you have to confront the issue that banning fracking or significantly reducing amounts of U.S. fracking will have a meaningful impact on global oil prices, meaning it will lift them. It will tend to lift them up a lot, potentially.
Yeah. And the U.S. Employment situation.
Yeah, it's a very thorny issue.
So going back to Saudi, as they're thinking about, I do think that the way to think about this is to understand them as pulling forward future profits.
And why do they need to do that?
Why? What is the plan on that, and what are they going to then do? I mean, it's kind of fascinating to look at the total dynamics, not only in Saudi but in the Middle East overall, with America now as a net exporter, and just the not that there's not still strategic importance to the region. There certainly is, and instability there is not good for global markets. But the involvement, the concern, all that stuff, that it's just changed the situation on the ground and what it all means. So what are the Saudis trying to do exactly?
Yeah, that's I think really the question is to try to potentially bring to cash out ahead of that declining demand with the renewables and alternative energy sources really coming in. There's a sense that the Saudis, at their current pump, they're not going to get all this out of the ground, and with the kind of developments on the energy front and the movement away from fossil fuels. So there's But
I would expect in the next 5 to 10 years a massive building boom in Saudi Arabia, because the wealthiest families all own construction companies, and this is kind of a way to get those families the future profits from the Aramco IPO. So you'll kind of build a couple new cities and employ people.
Yeah, right. And you can plow that money into other investments, investing in other parts of the economy to try to diversify away. And surely they're thinking in that vein as well.
And that's been the path to growth that MBS has laid out. He's been pursuing, I guess you'd call it reforms, though there's multiple sides to that.
No, I mean, I think he was chosen as much as the face of the Aramco IPO as necessarily the big reformer of Saudi Arabia.
Yeah, it's interesting to watch that IPO, and as you talked about the valuations on some of that sort of stuff, and then Saudi is also one of the big investors in the Vision Fund.
Yeah,
and through that WeWork and some of the other IPO numbers that haven't quite hit their mark either.
No.
It's interesting to watch when you're trying to see the money flood into the markets in that zone, and what does or doesn't materialize on the back end in terms of what they're trying to do.
Well, that's another great point where a lot of money is going to be produced from this in a world that is awash with money and has found its way into some bad investments. WeWork being probably number one on that list.
Yeah, it is. Yeah, it is interesting of whether this is the time to pull forward the money for investing, because then what do you invest in?
Yeah, I know. So there's $77 billion in untapped private equity money that is just waiting to be invested.
Yeah. Ooh, I got some ideas. Call me.
If they follow the it'll be interesting to see if they follow a construction boom path for some of that stuff. Then how do they who goes in those cities? I mean, China, people talk a lot about China building these ghost cities or whatever, but China's got a billion people
to put them in. Yeah.
I flash back to when I was at a hedge fund, I used to cover China, and one of the things that, among other places, and one of the things that ghost cities obviously came up a lot. And one of the things that the counter argument would be, and you would get this when you went to China, they would say, they're have been lots of ghost cities in China. You know, Pudong was a ghost city when they built it across the river from Shanghai. And I remember that I was in China in 1993 standing on the Bund, and I looked across there were no bridges across the river, and they were building this awkward-looking tower, which is the CCTV tower.
Yeah.
And we sat there and said, why are they building that in the middle of the rice field? Well, kind of a failure of vision on our part, but it's kind of a funny formulation, sort of a glib rejoinder to the ghost cities thing. But that's what a lot of modern Chinese cities started as.
Yeah.
They were just put in place.
Yeah.
And people came.
Yeah. Great. What do we have coming up for the coming week and as we enter into the home stretch before the holidays here?
Yeah, so next week's a very busy week. In terms of data, we get those global manufacturing PMIs, the Purchasing Managers Index. So it'll give us, again, a sense of how much the trade war with China is affecting the global manufacturing economy. We also get the Consumer Price Index in the United States. So the Fed has a dual mandate, both inflation and full employment. They seem to be doing quite well on the employment, as shown today, but the inflation numbers have kind of been below their target. We also get November retail sales, so we'll see how the consumer's holding up going into the Christmas. But the big ones, we had two big central bank meetings. So the ECB will be the first meeting for President Christine Lagarde. They kind of did all the big stuff at the 2 meetings ago, so very little is expected, but at least we'll kind of hear from her at the first meeting. And then we also get the Fed on Wednesday. So they'll have that CPI reading, but more importantly, they have these 266,000 jobs in November. So I think this gives them plenty of cover to pause. So this will be kind of the first one that the market's not expecting them to cut.
After 3 consecutive cuts, the markets are not pricing in a cut. They're pricing in a hold for a number of months. But casting an eye out into 2020, markets are pricing in another rate cut in 2020.
Going back to your Grinch kind of, it's funny, but it's true. The Treasury market is kind of the smart market. It's looking out in the future. And if they're expecting things to slow down, that's the only reason you cut,
I don't know if you guys had a chance to see, did the jobs numbers today materially impact expectations for next week?
We were at 94% chance of a hold. We're probably at 100 now.
Yeah, cemented it. Yeah, no question about it. The expectation has been that the U.S. and global economy is going to drift higher. It's stabilizing now and is going to be a little bit incrementally better in 2020 with the tailwinds of basically 12 months of major central bank easing in the pipeline, which, finger in the wind kind of takes about 12 months to really feed through into economic activity. And then the expectation of trade détente between the U.S. and China beginning to solidify corporate confidence. But they've got on the calendar a pretty big election in November, and if you're thinking about an investment, making an investment as a corporate management, maybe you might want to wait until there's next year is going to be a very interesting year with wide dispersion of outcomes after November, and so corporations might be a little more confident, but certainly will have something in the back of their mind.
Well, it's good that there's plenty on the horizon because we always need things to talk about. Thank you, everyone, for listening to the HPS Macrocast. I'm Matt McDonald with Hamilton Place Strategies. Thanks to John Fagan and Brendan Walsh of Markets Policy Partners. Have a great weekend.
Thank you for listening to the HPS Macrocast. Please remember to subscribe, rate, and share. Find more from Hamilton Place Strategies at hamiltonplacestrategies.com and follow Tony Fratto on Twitter @TonyFratto. Learn more about John Fagan, Brendan Walsh, and the work they do at Markets Policy Partners by visiting marketspolicy.com.